Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for January the 31st, the last day of January, and episode 232. I'm Dean Croak, market analyst here at DAT, sitting in for Ken Adamo, who's traveling again today, and I'm joined by Cassandra Van Kuren, who's our special guest today. Good morning, Cass. Great to have you on the show.
Good morning, Dean. Thanks for having me. I'm so glad to be here with you.
Yeah, you're one of our leading data scientists. It's a complex world, but if you get it right, it can be a very insightful role when you work in the transportation industry. Tell us a little bit more about what you do at DAT.
Yeah, thanks. So I'm actually an analytics consultant. I'm a senior analytics consultant with the data services team. We're like a professional services team. Customers can come to us if they want to find out more information, get more specialty data sets than they could out of the actual product. And I just specialize in visualizations and love helping customers workflow better.
Right.
Yeah, we come in, listen to how they want to work with data, what they're doing currently, and then make suggestions and help implement that. Yeah.
Right. Yeah, so being able to tell stories about data is absolutely critical. I learned that the hard way. A lot of customers will say to you, that's all great, but what do I do with the data now? Tell me what to do with it. So,
right.
Yeah, looking forward to bringing you back towards the end of the show to talk about produce season and what our market condition index is showing. Cass has got some wonderful analytics to share with us. So let's get into the show, folks. For those new, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market. Most importantly, though, we're here to answer your questions. Get them into the chat section. We've got a team of folks answering those in the background. They tend to pile up towards the end. So jump in quickly, get all your questions in, and we'll get those scheduled. So let's start with our market update and some of the key trends. Of course, overnight, we've just heard news. We've got a 1,000-mile long ice storm underway in Texas, running all the way from Dallas through Tennessee through Thursday. This is a pretty significant event reminiscent of the polar vortex in 2021, where it closed down the I-40. I-35 was closed last night, and if you know anything about imports from Mexico, that's one of the major corridors. Up to a half of an inch of ice is forecast in that region. And of course, freezing cold is going to follow later this week. -9 in Minneapolis this morning. Same here in Boston, -9 on Friday. So lots of cold weather. Be careful, folks. Brokers and carriers, lots of service failures will be inevitable during the course of this week as the roads ice up. Diesel up 2 cents a gallon to $4.62 last night. In other news, it's about 16 cents a gallon below the Great Recession high of $4.77 and about 78 cents higher than this time last year. On the spot market, rates dropped last week. Again, no surprise there. Rates typically decrease in early January from their late December highs. They're down 14% so far in the first month of the year. Typically, rates over the last 6 years decrease about 9%. So they're accelerating a little bit quicker than what they would have done prior years. Load posts within about 5% of pre-pandemic average. So pretty healthy load post volumes for early January. The problem is that equipment posts, problem for carriers, that is, equipment posts are about 26% higher than what we'd normally see over the prior 6 years. Capacity continues to overshoot demand in the spot market, making our load-to-truck ratios at the lowest that we've seen in 7 years across the three equipment types. Some good news last week. ATA Chief Economist Bob Costello said that these total tonnage for the ATA Truckload Index up about 3.5%. Best annual gain since 2018. Notably, though, Bob said that for hire tonnage clearly decelerated during the final quarter, but ended up being a solid year for truckload freight tonnage. Remember, ATA is heavily weighted towards the contract freight side of the market. Net interstate capacity, we look at the net reactivations and new carriers coming into the FMCSA, those that have to get a DOT authority and those that are revoking their authority. We've been losing about approximately 2,000 carriers a month since October last year. So we're anxiously watching that to see when the market turns and capacity starts to move back into the positive. But for the moment, we're still losing capacity in the market at a pretty good clip. So let's go into our load to truck ratio for dry van. Last week was, of course, the last whole shipping week of January. Normally you see a little bit of a bump towards the end of the month. Volumes were up 2%, but down 39% since the start of the year. not much of an end of month or shipping month as we would normally see. Compared to week 4 last year, load posts are about 68% lower. Equipment posts are about 35% higher over the same time frame. So as a result, the load to truck ratio increased ever so slightly to about 2.20. That's about 4 times lower than what it was this time last year, though, as a measure of how much things have changed. In the refrigerated market, the winter produce market continues to dampen demand for reefer carriers. Nationally, last week's volumes were down by almost 9% year over year, according to the USDA. That's about 2,500 fewer weekly truckloads. In the spot market, reefer load post volumes, including produce, these are total volumes, were about 11% lower last week. Carrier equipment posts running about 30% higher than this time last year. So as a result, the load to truck ratio moved up slightly to 3.17. As you can see, they're the lowest in 7 years for the end of January. And in the flatbed market, volumes were up almost 2% last week, still about 80% lower year over year. Load posts are around 23% lower than the pre-pandemic average for week 4. Load posts are about half what they were in 2018, also as a measure of how much things have changed. Carrier equipment posts at their highest level in 7 years, about 73% higher than this time last year. The load to truck ratio for flatbed remained relatively flat last week at 11.35, the lowest it's been since 2016. Having a look at our market condition index, which Cass will come back and talk about a bit later, Ari Ash at the Journal of Commerce reported a major disruption last week to West Coast freight networks. But a 72-hour emergency repair to the bridge in New Mexico averted a crisis. Union Pacific did halt all container traffic moving between Southern California and the Midwest for automotive and containers between hubs in Los Angeles and Chicago and Kansas City. We did see a little bit of activity on the spot market. Truckload volumes were flat between Los Angeles and Chicago. However, capacity did tighten last week slightly. Spot rates reached a 4-month high on that lane of $1.53 a mile. That's still half what rates were this time last year when they were $3.02 per mile on that long haul lane. Capacity was very tight in Flagstaff, Arizona last week, following a 61 cents per mile increase in outbound spot rates, averaged $2.51. State level outbound rates in Arizona the lowest at $1.33 in 5 years, though. However, on the high volume lane north to Las Vegas from Flagstaff, spot rates were $2 a mile. That's a 4-month high in that market. And after dropping for the prior 3 weeks, spot rates northbound out of Tucson, which also includes Nogales, Arizona on the border, market rates increased by a penny per mile to $1.46. Higher cross-border import volumes impacted spot rates further south in Nogales on loads to Ontario, California. Rates up 20 cents a mile to $1.41. That's still still 25 cents a mile lower than this time last year. Having a look at our produce market, which will be the focus of our question of the week, some USDA data in last week, lower produce volumes in key winter markets, Florida, Arizona, California, down about 33%. That's weekly truckload volumes down 33% compared to this time last year. Florida season's getting started, albeit a little bit later due to Hurricane Ian late last year. Volumes are about 30% lower than this time last year. We're still a long way from May's peak shipping volume, though. State level rates in Florida for reefer carriers at $1.33 per mile are around the lowest in the last 7 years, as spot market volumes remain flat for pretty much all of January, reflecting the impact of the weather. Of course, this week is peak shipping week for Valentine's Day roses and carnations, so we expect reefer capacity to increase dramatically in the next couple of weeks, particularly this week. For those that don't know, about 90% of Valentine's Day roses and carnations will land in Miami, at the Miami airport, from Central and Southern America. Having a look further west in Arizona, home of the Winter Salad Bowl in Yuma and this year's Super Bowl in Phoenix, produce volumes are about 25% higher across the border. Nogales was the only border market last week. In fact, only one of 18 produce markets tracked by the USDA to report a slight shortage of trucks last week. All other markets reported an adequate supply. California, Florida, and the Yakima Valley all reported a surplus of trucks, slightly unusual for this time of the year in those markets. Of course, produce volumes in California are still reeling from recent wet weather. Truckload volumes down around a third of what we'd normally expect. State level rates for refrigerated carriers averaged $2.20 last week. It's It's about the same as what it was in 2020. Volumes are down a little bit. It is the slack season. We're in between seasons there, so not too much alarm. The recent wet weather should boost the outlook for produce volumes this year, unlike last year. Having a look at the flatbed market condition index, all those state level rates in Texas cooled again last week, dropping by about 4 cents a mile to $2.11. They're still the second highest flatbed rate for the state in the previous 7 years, with only last year being higher when outbound rates averaged about $2.53. So in McAllen, Southern Texas, flatbed rates were up last week by 7 cents a mile to $2.16, while loads 350 miles north to Houston up I-35 were around 30 cents a mile higher than the December average. They averaged $2.41 last week. In the Pacific Northwest, the big market for flatbed carriers for lumber, load posts were up 20% week over week. Much tighter capacity reported in Medford. Spot rates in that market up 36 cents a mile to $2.59. Medford to Stockton around 10 cents a mile higher at $3.93. And on the high volume lane from Medford further south to Ontario, California, rates averaged $2.35 last week. And wrapping up, flatbed capacity was very tight in the southeast last week. Rates were up 3 cents a mile across the board, averaging $2.26. Most of the gains were in Mississippi. Spot rates jumped 12 cents a mile to $2.52. Regional loads to Houston were around $2.18 a mile last week, and where rates have been for the last 3 months, still around 33 cents per mile lower than the previous year, but nonetheless tight capacity in the southeast. Having a look at our year-over-year look at spot rates, following last week's 5 cent per mile decrease to $1.80 per mile, the national average dry van rate has dropped 16% since the start of the year, a slightly higher rate of decline in prior years, including the last two pandemic-influenced years. Dry van spot rates in the previous 7 years typically drop about 11% during the year's first month. Last week was about 11%, hence the slightly higher rate of acceleration in the downward rate. At $1.80 a mile, line haul rates are about 91 cents a mile lower than this time last year, and 25 cents per mile lower than the top 50 dry van lanes based on volume of loads moved, which averaged $2.05 last week. In refrigerated, national average reefer line haul rates continue to cool faster than other equipment types. Last week, rates were down 8 cents a mile to $2.10. Remember, folks, these are line haul rates excluding the fuel surcharge. Including the last two pandemic years, reefer spot rates in the last 7 years have typically dropped about 9% during the month of January. This year, it's 18%. So line haul rates have dropped about double the normal rate we'd expect, reflecting some of the lower volumes in produce, no doubt. Following last week's decrease, spot rates are $1.07 per mile lower than this time last year, but still about 10 cents a mile higher than this time in 2018. Having a look at flatbed, the year-over-year view is very interesting. Flatbed rates have lost the least ground since the start of the year, following last week's 2 cent per mile decrease. Including the last two pandemic-influenced years, flatbed rates in the previous 7 years have typically decreased by about 6% during the first month, compared to this year's 10% decline. At $2.08 per mile, flatbed line haul rates are about 58 cents per mile lower than this time last year, and just 7 cents per mile lower than in 2018. So that's it for this week's market update. Remember, if you want to find out more in freight, go to dat.com market update /market update and download our weekly report, which I've written, and it'll be available sometime later this evening at that URL. So with that, let's go to the short-term forecast. Let's start with dry van. Just to level set for those new to the show, the blue line is a rolling 7-day weighted average of historical rates for actual loads moved over 550 miles, excludes fuel. So this is line haul, long haul only. Our flagship model rate cast, which is in all of our products, is in green. Red is the short-term model that more heavily weights data seen more recently, and then you have the yellow and grey blends of the two in varying degrees and mixtures. So unlike last week where the models were in disagreement, in dry van this week there's more of a consensus that the bottom is near, although Ratecast expects rates to bottom out at just under $1.75 per mile. Refrigerated, similar story. We're seeing a little bit more pessimism though with the short-term model outlook this week. Again, I think that's reflecting the produce season slow start. we're a ways away from having a meaningful impact on produce season. It really doesn't get started until April. So there's more downside, I think, than upside on the produce side of the market as it affects reefer carriers. Ratecast is forecasting reefer rates to bottom out at around $2 a mile, excluding fuel. That's about 10 cents a mile lower than where we are at the moment. Of course, weather has impacted produce volumes in California significantly and delayed the Florida season. So I'm sure the short term is picking up on some of those data points. And then to wrap up with Flatbed, all four models are seeing a more bullish outlook this week, despite all the headwinds this sector is facing. The housing market has, of course, put some dampener on demand for flatbed carriers. Even though the short term in red has long haul rates still above $2 per mile, it's only about 3 cents per mile lower than where we are today. So flatbed outlook is looking a little bit more positive than where we were this time last week. So remember, these are for long haul loads over 550-mile line haul only. So with that, let's go to the question of the week and bring in our special guest. Cass, what does our market condition index tell us about demand in produce markets?
Yeah, thanks, Dean. So I'm sure our audience is familiar with what MCI is, but I'll level set really quick with everyone here. We say MCI for Market Conditions Index, and it's a cleaned and geographically normalized capacity metric that we've derived from the load to truck ratio. So when we say cleaned, we look at typical usage for an account and remove anomalous behavior at the account level. And geographically normalized means we're looking at geographies and we're weighting them by their percentage of the national volume. And this allows us to have a conversation. This allows us to compare markets to each other. So for example, without weighting, you wouldn't want to compare Ontario, California with a backhaul market because Ontario would just dominate the conversation. But we geographically normalize them so that we can look at them all on one map and provide an MCI score for them all in one day. So MCI is presented in a couple of different date ranges. We have historical MCI, we have current business day, and then an 8-day forecast. And the 8-day forecast incorporates searches into the algorithm, if you will, along with some other exogenous variables. And we look at that forecast when we're taking a look at a market and wondering if the capacity is going to be tighter or looser in the next week or so. So the way we visualize MCI, the MCI score, it's on a scale from -100 to 100, is with colors. And we apply the hot color or the red, the orange to red colors to markets that we deem tight capacity on that day compared to all other markets. Right. And then the cooler color, the blues, are assigned to those with looser capacity.
Right.
Yeah. So
yeah, it's an interesting question. On our market condition index for reefers this week, we saw some very interesting color palettes across the country. A lot of cool blue colors, of course, where capacity is pretty loose, but we started to see some interesting color changes in some of the produce markets. So when you look at our MCI this week, you can see Ontario, Arizona, southern Texas across the McAllen, Laredo markets. And then, of course, in Florida, where this week we can see some reds and oranges emerging. And of course, I think that maps to what we've been talking about with the changes in market demand. So, Cass, what's MCI predicting in coming weeks? What's the outlook look like?
Yeah, so I do want to touch on the fact that when MCI is deeming a market tight, again, it's compared to all other markets on that day, and we assign the red color. So that's why you may see red or tight markets even when the market as a whole is looser than other years. So that's good to keep in mind when using MCI. That's one of the major questions we get, and it's good to just kind of level set with that. Right. I like to just tout how there is a correlation between MCI lagged and the Fed yield curve. So on a macro level, when we look at national MCI scores, we find that MCI is a predictor for the Fed yield curve. And this is good news for everyone out there wondering when the 2022 price drop is going to stop. Lately, we have seen national MCI outbound start to tighten back up at the end of 2022. So We're hoping that overall capacity climbs out of its 2022 slump, like the macro economists and investors have been predicting for Q1 of 2023. So good news there. We are seeing MCI start to climb, and usually we see the Fed yield curve follow it.
It's interesting, Cass. I saw some words from Jerome Powell this week where they were talking about a very shallow, quick recovery type recession, if there is one. So that's excellent news. Thank you.
Yeah, and we are seeing that with the MCI curve. So MCI has been dropping. Again, this is national outbound MCI. We compare to the Fed yield curve. They've been dropping in tandem now for the whole of 2022.
Right.
But good news, it's turned around. So let's cross our fingers that happens for the economy as well.
Right.
But let's pivot from the macro lens into focusing on Miami and Lakeland in Florida. Where produce season is starting to ramp up, especially for Valentine's Day. So every year we see rates and capacity tighten in the south to north wave as produce moves from our southern border states, right, on trucks to consumers to the northern border states. And produce starts to grow in the hardy zones first, which is right now, that's the Florida region, which is warmer, of course.
Right.
So talking about the first produce we see of the year, the U.S. is ramping up for Valentine's Day now with roses and carnations out of Miami and then berries out of Lakeland coming up on reefer trucks. Yeah.
And so for carriers looking at that, I mean, it's a tough area to get to, right? You've got to be very careful about how far you run deep into Florida before you come back out. Rates are historically low. A lot of carriers typically say, they load into Florida, but always take their backhaul with them. They load it up into the head haul rate. But this is a fairly short-lived season. So talk us through how the MCI for refrigerated in, say, Lakeland, which is the big market right now for produce in particular. I mean, you're going to be seeing all sorts of things coming out of like beans, cabbage, corn, peppers, radishes, strawberries, tomatoes. There's a lot of winter vegetables coming out of Lakeland, but of course it is the heart of strawberry and blueberry production. We've got the Plant City Strawberry Festival coming up on the 2nd of March, a little bit delayed this year, understandably. So it's a huge market for strawberries, and then they change their crops over into other vegetables. So for carriers, this is a pretty big market around Lakeland, which of course encompasses Orlando. So it's kind of that central Florida region. It's a very distinct region for growing produce. How does it stack up compared to, or how does the MCI forecast stack up to prior years? So, brokers and carriers and shippers can get a feel for what capacity and rates look like.
Yeah, great question. I think now carriers might be wondering if they should head down into that area. So I see an 8-day MCI reefer forecast predicting capacity tightening between today and into the beginning of next week. And we're predicting extremely tight capacity out of Lakeland for the next week or so. So that might get you the load you need to get out of Florida, right? And that's the whole point of getting there. So when I look at, January 2023 in a year-over-year analysis, when I compare the capacity to 2019, 2020, 2022, I am seeing that capacity now is close to where we were in 2022. So it was pretty strong last year, and it seems to be following the last 2 years. So we started out with tighter outbound capacity from this area, but then peaked in line with 2021. And we're predicting that 2023 is going to do the same thing. So I think you should have your loads out of there if you want to get down to that market. Yeah.
And of course, a lot of the guys that I know that run, or guys and girls that run out of Lakeland with dedicated produce, some of them are already moving over into the Miami markets. That's why capacity is going to tighten in Lakeland, even though it's not peak produce season. When those trucks move around to avail themselves of some of those hot loads in the next 10 days, that could be a little bit of relief after what's been a pretty bad couple of weeks in terms of outbound spot rates for reefer carriers down there. Cass, we've got a few questions lining up, but I did want to ask you one question. What's the most impactful data analysis that you've done for a customer, and how did it make a difference?
Yeah. I always love hearing from them afterwards. Sometimes you make something and it goes out and you never know what kind of impact it had. And so the ones that I remember are when they come back to me at a trade show, or maybe talk to a team member and say, how much a dashboard made a difference in their day-to-day work. And that's really what I live for. And I think one of the examples was help with RFP work. So before DAT released our new RFP tool, we were engaging with customers in specialty work to see how we could make their RFP work go faster. And I just remember a customer coming up to me afterwards and saying it made her work flow just so much more streamlined, and that just made my day. Like, that's really what I'm here for, right? Really what we were doing was putting a spark line so that she could see how the rate flowed for the last couple of years in each row of her data. And that just made her work like that much faster. So that's one example. And gosh, I've made so many dashboards in my life that I think another one is benchmarking. So benchmarking is really important to our broker and shipper customers. They want to look back and know, where did they not do so well compared to market? Where did they do better? And really, it's those benchmarking dashboards that help them know what to work on in the future that I think have made a big impact.
Yeah, very interesting. All right, let's dive into some of the questions before we wrap up the show. Isaac asks, when can we expect refrigerated rates, I guess, come up in terms of pricing across the board? I think based on our forecast, we're looking at end of March, early April before we start to see some meaningful impact of produce season. That's about normally when it happens. Look for the Vidalia onion pack date in Georgia in early April. That's officially the starting line of the produce season. That's a date that we look. Produce volumes are going to increase, of course, out of Florida. The Humo winter salad bowl season is going to wind up towards the end of March, and then the Salinas season is going to come on board out of California. So I think it's going to be April before we start to see meaningful produce volumes that start to have that seasonal impact on reefer rates across the board. And typically they'll run all the way up until about probably July 4 is when they peak. We would normally see from April through July 4 something like about a 20 cents per mile change. Still a lot of capacity in the market this year, so that'll impact prices. And of course, we covered diesel at the start of the show. That's going to have a big impact on that sector. Another question from Mahalio. Are nursery shipments from Florida expected to affect the volume and rates in that area? So when you look at ornamental volumes as distinct from fruit and veg volumes, ornamentals, of course, are all of our Florida arrangements. Most of those in the next week are going to be carnations. I think it's about a 70% mix, 70% roses, 30% carnations are going to come out of that particular market. You're going to see right now this week dozens and dozens of 747 jumbos landing in Miami from Ecuador and Colombia. They'll come in every single day right up until Valentine's Day. Some of the big carriers have already got surcharges in place and deadlines for shipping. So I think right now, this is, when I looked at last year's 2022 peak volumes by week, this is the week for peak volumes out of Miami Airport in particular. Next week's volumes are down about 10% on this week based on last year's data, and then they drop right away, of course. A lot of it's going to be team freight, given the time-sensitive nature of it. Truckload carriers are not overly enthused about live load boxes of roses in little florist stores that don't have forklifts. So it's not all, roses and chocolates for carriers this time of the year. But this week is the week to answer your questions specifically. So that brings us right up on time. Cass, anything else you want to throw in there about MCI or anything else we should be thinking about in coming weeks?
Sure. So how can carriers put MCI to work for them? Carriers can use MCI outbound with the origin and destination to assess where you are, where you want to be, where you don't want to be. As a carrier, if you're being sent into a really loose market, you can use that as negotiating power. And where you're going, it might be more difficult to find a load out. And so someone wanting you to go into that market should take that into consideration when negotiating your rate.
Right. And of course, you can do prior 7 days of MCI in a particular market. You could do next business day or next 7 days. So there's a number of ways to look at a market. If you're sitting in your truck and you've got your laptop open, you can actually do some different sets of analysis with it and see what the capacity is forecasting. All right, Cass, it's been really good. I'm sure the viewers benefited from learning a little bit more about our MCI charts and our different colors and what they mean. We'll wrap up the show with some shout outs. I'll be on Sales Chatter with Dan Deegan, Ryan Mohammed, and Jeff Dickinson tomorrow at 9 a.m. Eastern. You can connect with them on LinkedIn. Robert Rouse from DAT will be on Landline Now on Wednesday, 7 p.m. on Sirius XM channel 146 Road Dog Radio. Don't miss the latest edition of Freight Vine with Chris Kaplis, Anam Ayub, and special guest Ari Ash from the Journal of Commerce. Don't miss that one. Remember, if you want to find out more about the details behind this week's market update, go to dat.com/market update. Of course, you can also see it on our new IQ dashboard at iq.dat.com. If you've got any specific questions, send us a note at askiq@dat.com. And with that, it's time to wrap up this week's show. Thanks for watching. We'll see you here next week at 10 a.m. Eastern, 6 a.m. Pacific, 7 a.m. Pacific, sorry. Have a great and safe week, everybody. Thanks for watching.